Hey everybody, welcome to our YouTube channel. My name is Glenn Tompkins, Senior Instructor here at VectorVest on our YouTube channel. Love bringing these videos to you. And this one is going to be an important one as well. Is a recession on the horizon? Well, before you start running off into a tangent and thinking that this is all about fear, it's nothing like that. It's about educating you on what's going on in the current market's conditions and see if it's going to add towards a recession and when about. I'm not going to predict, but I'm going to tell you what to look for to know when a recession is about to happen. If you're interested to know what the information or the analysis says, you sit right there. Hey everybody, Glenn Tompkins again here on our YouTube channel. Love bringing these videos to your attention. If you're brand new to the channel, I invite you right now, hit the subscribe button, hit the bell icon so that you'll be alerted to when new videos like this come out. And if you like the commentary, by all means, hit that like button and talk to me in the chat. I want to know what you think about what I found out here in regards to, is a recession on the horizon? All right, let's get right into some of my web stories that I've got here. And let's start off with interest rates, because that's what's going on to go after inflation. Inflation is when prices rise because the market is firing off on all cylinders and it's rocking and rolling. And now prices rise. You don't want it to rise out of control. So the Fed, the main tool that they have to go after inflation is to start to raise or bring up or raise interest rates. Now, the thing about this is, for the longest time during COVID, when they were pumping a lot of money into the economy to keep it going, to keep it boisterous, to keep it rocking and rolling, to keep us from going into a recession because of the way COVID hit us, they put a lot of money into the economy. It made it real easy for people to borrow money at a lower interest rate so that they can do the things that they needed or the things that they wanted to do. And this is especially important for companies. Companies, as a way of doing business, will borrow money so they can invest it in research and development, so that they can hire new people, so that they can make the business better. That's a good way for them, outside of making money on the stock, to grow their business. And if interest rates are historically low, it makes it real easy for them to finance all of the things that they're trying to do. Now, when doing that and the market is rocking and rolling, prices are automatically going to go up. That's part of the game, all right? So you want to make the economy rock and roll. You want people to spend money, and you want the economy to go, and you don't want it to fall down or go into a recession. So now that the prices are rising, and they kept using the word transitory, that inflation was transitory. Oh, it's okay. It's running hot, but it's okay. That was not what was going on. Inflation was becoming an issue. Higher prices were becoming an issue. And you know who else it hurt? It helped the people with wages. Now, let me say this. Wages have gone up the most in the past few years than they have in quite some time. Well, why is that? With rising prices, you've got to raise wages. And as you do that, what does that do to a company? It takes away from the bottom line. Now, even with raising the wages for people, was it keeping up with the inflation? And the problem is with that, no, it wasn't. People were getting raises. You look at all of the news going around, McDonald's is hiring at $15 an hour. Who thought that that would ever happen? And they're giving on sign-on bonuses. Why? Because they need the people, and in order to get the people, they needed to raise wages. Now, even with that wage raise, say that 10 times fast, even with that wage raise, inflation was running so hot that they still could not keep up. People are not being able to buy the things that they need. And how do we know that inflation is going up? Have you been to the supermarket lately? Have you been to the gas station lately? And, you know, normally those two things are really not incorporated in the inflation number, but they should be. There's a couple of different inflation numbers, say CRB, CPI, blah, 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 blah. But nonetheless, America is feeling the rise in, feeling the sting of rising prices in their pockets. There's no ifs, there's no ands, no buts about it. So What happens when the Fed raises interest rates? Well, there's a lot of talk recently about the Fed raising interest rates. And first, remember that the Fed Reserve only actually sets interest rates for banks. Specifically, the Fed sets two interest rates. The first interest rate is called the discount rate. It's the interest rate the Fed charges banks for an overnight loan. And the second rate is called the target rate. And this is the interest rate the Fed tries to achieve via the open market operations. And this was the number they said was transitory. All right. Now, since the monetary crisis has started off the Great Recession, the Federal Reserve target interest rate has essentially been zero. All right, to keep money, make it easy for people to borrow money. The purpose of such a rate is to make it more worthwhile for banks to lend money. The idea is that more money in the economy stimulates additional growth. The economy is still growing slowly, but it's still growing, which brings us to raising the interest rates. And that's where we are right now. First interest rates came out rising about 0.25% or 25 basis points. I think that the Fed is going to have to get more hawkish to effectively go after inflation that they thought was transitory. I believe they came late to the party to go after inflation, and now they're going to pay the price. And in order to get more hawkish, they're going to have to raise it at even a faster clip. We'll talk a little bit about that in a second. Now, why are there growing fears in the U.S. that the U.S. is headed into a recession? And that's why we're doing this video. The fears come up. People are searching on it. A growing number of forecasters now believe a recession is on the horizon as the Federal Reserve gears up to raise interest rates sharply. See that word? Sharply, to combat the highest inflation in more than 40 years. Inflation is a problem. It's an unusual outlook at a time when the economy is strong by many measures. Companies are still beating or meeting their earnings expectations. Now, the problem is the forward guidance. Even though they're making money, the interest rates being raised haven't really truly affected them yet. Wait until Q3 or Q4 of this year, then companies should be affected by the interest rate hikes. It's going to make it tougher for them to borrow money, and if that's the case, it's going to affect the bottom line. But it's that strong economy, and particularly the sizzling labor market, as employers try to hire more workers to meet the surging consumer demand, that has economists concerned. So jobs are out there, but a lot of the jobs are lower paying jobs in the service sector, and the wages that are being offered still may be higher than they have been in many years, but not enough to keep up with inflation. All right, as employers scramble to find scarce workers, they're bidding up wages. And that's helping to push inflation even further above the Fed's target rate of 2%. All right, so now another story. Fed risks are rising. Investors have become increasingly nervous about the Fed's Reserve's aggressive interest rate hiking cycle and a reversal of pandemic-era stimulus programs, a prospect that now has many on Wall Street sounding the alarm about a potential impact to the markets and the economy, which is true. Banks of America chief investment strategist Michael Harnett warned in a note on Friday, recession risks are rising, as he sees a scenario in the next 6 months where rates shocks morphs into recession shock. All right, let's go on to another story. Now, this is a different story. Why near-term recession is unlikely. Now, as we go down into this story, calls for a downturn have escalated in recent months amid soaring inflation. Inverted Treasury yield curves. Patrick did a great video on the Treasury yield curves and the specter of tighter monetary policy from the Federal Reserves. Goldman Sachs economists said they placed the odds of a recession in the next year at only 15% and in the next 2 years at 35%. A recession is defined as 2 consecutive quarters of negative growth in the country's gross domestic product. So now before a recession happens, these are some of the signals that you will see. You will, one, start to see the economy start to slow down. Two, and you'll see this most especially in the GDP going down for 2 consecutive quarters. Has that happened yet? No. The market's still too hot, and GDP is still coming in and is looking good, but it's going to start to slow down. As it's not just Wall Street's, and this is another reason why this video is being done. Google searches in the US for how to prepare for a recession nearly tripled over the past week alone. There's a lot of people out there asking about, are we getting near to a recession, what to do, those kinds of things. And again, that's another reason why I wanted to put this video together for you. It's not about scaring you. It's not about Katie bar the door, go hide the babies and all that kind. It ain't nothing to do about that. This is giving you an understanding of what's going on in the current market's conditions and how this could morph into a recession at some point in time, but at least you're going to have some education about what to look for before that happens. Now, this is from the Fed. Fed's daily says the economy can handle the rate hikes, but a mild recession is possible. This is more recent, all right? San Francisco Fed President Mary Daly acknowledged that a series of rate hikes over the coming months could tip the economy into a recession. Folks, this is coming from the Fed now. This is not coming from all the talking heads. This is not coming from a YouTube provider. This is coming from the Fed. The central bank official noted she doesn't expect that to happen, and she said any period of negative growth likely would be mild. But the possibility of a recession, mild or not, is there. All right, so now, what is the positive side to all of this? And looking at rising inflation and then going after it with raising interest rates, and I still think that the Fed is going to have to get a lot more hawkish on these interest rates to effectively calm down inflation, because I think it's out of their control. They came late to the party, and the interest rates are going to be the only way I think that they can afford to go after it. And I think that at some point, they're going to raise interest rates, probably 100 basis points. And a lot of you may out there say that you're crazy, Glenn, because that'll put us into a recession. What else can he do? Think about it. Look at where inflation is right now. It's the highest it's been in over 40 years. What else can you do to keep a balance to effectively go after inflation? Now, the thing is that on that balancing, he was trying to keep us on a soft landing. I think inflation is too far out of play for him to now bring us into a soft landing. And I think that he's going to have to go after at least 50 basis points for the next 2 or 3 interest rates. And something else to keep in mind, that this is a election year. And I don't know how he plays, how Powell plays into that, if he cares, if he doesn't care, if he's getting some political pressure to hold off until towards the end of the year to do that big push, which I think he will have to. I don't know. That's just me talking right now. So the upside to all of this is earnings. Now, Procter & Gamble CEO doesn't see a recession after a big quarter for consumer products giant. That's what's key here. Earnings is the engine that drives a market higher. Currently, we're in a bull market still, and I'm going to talk to you a little bit about that in a second. We're still in a bull market, and if earnings keep meeting or exceeding their earnings expectations, the market's going to still remain in a bull market. It is the engine that drives a market higher. So when will a recession start to take form? When companies start to miss earnings on a bigger proportion than what's going on right now. More companies are meeting or exceeding their earnings expectations, but once they start quarter 3, possibly quarter 4, start missing earnings and more companies start missing earnings, then you know that the raising of the interest rates are affecting a company's bottom line. It's not there yet. So now I went out the fact set. All right, let's talk about that. Companies are still reporting earnings growth. It's interesting to note that despite negative impacts, what negative impacts? The war in Ukraine affecting the ability to get stuff. rising interest rates, and things like that. They have reported aggregate year-over-year earnings growth of 18.5%. In the VectorVest software, we have projected earnings at 20% right now going into next year. Now, as companies get affected by the rising interest rates that could affect their bottom line, then that number will start to decrease. That's another sign to let you know that the market definitely, that the economy definitely is slowing. And at some point in time, by slowing down the economy is going to go, and then it's just going to fall. All right. By how much, I don't know. But it could be a recession at some point in time. Again, I don't know when. I think personally, my personal opinion is sometime next year. All right. That's my opinion, because the Fed is going to have to go after inflation a lot faster, or a lot heavier than they are right now. All right. So keeping all of this in mind, let's look at what the VectorVest system has to put in place for you. Here's our market timing graph that's looking at the VectorVest composite. The VectorVest composite is an indexed arithmetic average of all of the stocks that we track. You're looking at right here on the move of over 9,000 stocks. Today, a big down day in the market, but I want to show you an indicator that we've been talking to our customers about called an inverted head and shoulders, which tends to be a bullish signal. We have a shoulder, we have the head, and we have another shoulder. Now, as we look at these shoulders will create some semblance of a level of support. We do have a neckline right here, looking at the armpits of both of these shoulders. That's going to be what I'm looking for to see if the market has more upside potential. On our VectorVest composite, we have a price of $64.37. But what I'm looking at right now is even with earnings making or doing what they're doing, I'm watching that people may be a little fearful about what's going on with interest rates. Interest rates are about to rise again very shortly. We had our first one. We have another one coming up shortly. Most likely it's going to be a 50 basis points rise in interest rates. But look at this big down day today, right at this line of support connecting the two shoulders. Notice that it stopped. It didn't go below it today. If we do fall below that and then fall below the head, the market will then have more downside potential, which would be very interesting, especially knowing that the market is still good, or that the economy is still good if companies keep meeting or exceeding their earnings expectations. So now I'm going to give you a 30,000-foot view that we give to our VectorVest subscribers as well, something called the market climate graph. Now, the earnings trend indicator takes all of the market information and puts it on a scaling between 0 and 2. Above 1, the market's in a bull market. Below 1, like we were back here during COVID-19, which we didn't get into a recession because the market pumped so much money into the economy, the market did go into bear market territory, but a recession didn't happen. All right, a recession didn't happen because we put so much money into it. And look at the rise. Look at the rise of the market activity with all of that influx of stimulus. We ran, but what's going on right now? The economy is starting to level out and stall out right now on that scaling between 0 and 2. It's sitting at 1.36 above the value of 1, so the market is still in a bull market scenario. But look at the S&P index. Look at the S&P index starting to fall. Remember, this is the S&P 500. It's starting to fall. That's another signal. All right, so all I'm trying to tell you is that is a recession going to come? I believe that it will. I don't believe that it happens near term. It's not something that you wake up tomorrow morning and then say, oh, the recession is here. It's going to take some time. But with inflation running rampantly the way that it has, and with the Fed's only tool to be able to go after it is raising interest rates, and if they have to get more hawkish to really effectively go after it, then so be it. But understand, the economy is still going well. Companies are still meeting or exceeding earnings. There's a lot of jobs out there for people if they want to take them. But in order for companies to really aggressively get people to hold on to, they're going to have to raise wages. And if they do that, that's going to affect the bottom line. And then you're going to start seeing some of these companies start to miss earnings. All right. So hopefully, folks, this was just educational. If you liked it, what you saw, please, please, please hit that like button. Let me know in the comments what you think about it. And don't forget to share the video. Let other people know what we're doing over here at VectorVest, because we do the work and you reap the rewards. This video is over. And until the next time, folks, see ya.